If we are looking for a move ahead of FOMC or without FOMC factored, but I'm showing you how I did it today, you want to look at the FOMC holding pattern. So in other words, what pairs are being held in consolidation? Clearly, euro dollar was being held in consolidation in comparison and contrast to the Aussie dollar, and I'll show you those charts in comparison. But the holding pattern was for euro sideways, Aussie lower, which essentially will allow this pair to go up, euro Aussie. So euro Aussie shows bullish institutional order flow. So we go through the pattern of looking at the first pair, euro dollar. Well, it's neutral, so that means it's held in consolidation. The central banks are holding it sideways. If that's the case, then we know that Aussie dollar should be bearish. And when you check institutional order flow on its chart, it is going lower. It's breaking lows and highs are not being broken to the upside. The cross pair analysis is this. Euro Aussie is equivalent to going long New York Open, right here. Euro dollar is equivalent to taking a long, but only trading internal range. That means you're not looking for a breakout because it's not likely to do so. It's being held in consolidation. Aussie dollar is equivalent to taking a short in New York Open. So you can sell short Aussie dollar. You can go long euro dollar, but just know that you have to be using internal range liquidity for your targets because we're being held for what? FOMC. This is all going to change at 2 o'clock when the news releases. FOMC, the dollar is released, goes lower. All foreign currencies rise. That is algorithmic theory and how you use cross-pair analysis. Now let's look at this in relationship to the euro and Aussie dollar. Here's the 5-minute chart with euro dollar. Here's your propulsion block. Here, it trades down, rallies back up, and does not take the buy side liquidity here. Leaves it intact and holds the range. Trades back down into small little fair value gap, rallies back, small order block again, it trades back into, and then you see that expansion at FOMC. Then it attacks the buy side liquidity. But it's being held sideways, okay? It's being held sideways, even though it's making all these little short-term swings, and you can trade those. It takes a nimble person to do so, but the relationship of the cross-pair analysis, when you look at this pair with Aussie dollar is going lower. It's being allowed to break lows, so it's bearish. So it's going lower when it is not being seen in euro dollar. Euro dollar is being held in consolidation. That's what makes euro Aussie go up. So the way you use this information is if you want to see a trending breakout move, the better trade is to sell short Aussie dollar in New York today. The long in euro has to be a very short-term internal range liquidity setup, not looking for a breakout. Now I get asked a lot by my students, how do I know when the market won't go above old highs for a turtle soup or a run on stops? It's this right here. But I want you to think about how this helps frame when a market can be used to go long but not expect it to run out an old high, or for a market to go short and not to run out an old low, but also, more importantly, is to know which markets are going to be allowed to trend and have external range liquidity attacked. And what is that? We have the range here to here. It trades up and sells off. External range liquidity is the sell side here. Just like now this low to this high, sell side liquidity below here is the external range liquidity outside this dealing range here to here. This high here at redelivered rebalance and here trades up into that consequent encroachment and then sells off and attacks the external range liquidity there. Whereas running from this low up to this high relative to this high and this low, this dealing range, if you're counter trend trading and you're going long in here, looking for it to run back up to here, this is an internal range liquidity there because it's not taking out the previous range high.